Hey there, everybody. Happy Wednesday, April 23rd, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny Redmond, Washington. I also managed to just unhook my monitor. I don't know why I just did that as I was going live. I think it's back, so that's good. But good to be coming to you from a beautifully sunny Redmond, Washington here today. A number of people join me, hopefully viewers of this show join me for my webcast earlier today. We talked about the 4 deadly sins for investors, how we tend to buy too early, buy too late, sell too early, sell too late, some of the reasons why we do that, and some of the technical analysis tools that can help us minimize those. I hope if you did attend that webcast, I hope it made you think and just gave you some ideas about how you can upgrade your approach and analysis in the days and the weeks to come. Plenty to talk about today, to be honest with you. Again, the headline risk coming out of Washington continues to be very real. We're seeing headlines come out that are changing the face of the markets, I feel like, from one day to the next. In one day, tariffs are the biggest issue we've ever had to deal with. And then the immediate next day, it's obviously not a huge issue. It's a minor glitch, if anything. Powell's getting fired. He's, of course, obviously not going to get fired. So if you're wondering why the markets are volatile, it's because if you're trying to value companies and project interest rates and all of those things that help you try to determine what we should be buying when, all of these headlines just throw all of that into total haywire. So the good news is volatility usually means opportunity. And I put a post on my blog at marketmisbehavior.com earlier today about how volatility doesn't necessarily equal risk. Volatility equals opportunity. And so the more volatile the markets, the more the charts move. And that's a good thing, as long as you have the patience and the stomach to weather those short-term fluctuations. Hopefully what we do on the show allows you and empowers you to do so. Oh boy, that didn't work. So let's go to the charts. First, I'll share my screen. Here we go. This is what I was going to say. I accidentally unplugged my monitor. I didn't know where it would hit me. It hit me right there. There we go. Getting back, here's what happened today. The S&P 500 up 1.7%. Worth noting, earlier in the day, by the way, we were up all the way to about 54.70. We were up quite a bit more, but through the course of the day, the markets basically sold off. And after that initial gap higher, we actually made the lows of the day right around 12:15, 12:30 Eastern time. And from then, it was sort of a choppy, flat session going into the close. And so, definitely, there could have been a much more bullish trend to the course of the day. We did finish higher. It wasn't a big follow-through day, though, is a concern. I think that's, besides yesterday where we closed at the highs, a lot of the days that we've seen have been opening higher, close lower. We saw that all 4 sessions last week, closing below the open. This week has not started as such. This week has started a little more with a bullish trend through the course of the day. Something certainly to watch, but again, the end of the day, market higher, up 1.7% to 53.75. Still below that first kind of high water mark we talked about, 5,500, which we continue to focus on. So for now, we see this market is attempting to build momentum, but not quite following through yet. Growth over value was a story we'll hit on a number of times today. The FANG sectors were back at the top of the leaderboard. Growth stocks continuing to rebound. So the NASDAQ composite was up 2.5%. Mid caps and small caps all up as well. The large cap stocks generally outperformed small cap stocks, though growth outperformed value. The VIX continued to come down another 2 points. We're below 30 now. We're around 28.50. Still pretty high relative to, traditional standards, right? Still in that kind of high volatility environment, I would argue. When we get kind of into 20 to 30, some people call that kind of, I don't know what, neutral volatility or high, high but not extreme, right? Sort of above 30 is kind of a warning sign. Between 20 and 30 is like kind of high, and then below 20 is low. I've seen some people sort of break it out that way. I think more in terms of volatility regimes, and what we've seen is the entire volatility picture has become elevated since the February market peak. So we still have the market telling us we're going to get big swings in prices, and days like today and weeks like this continuing to deliver with those with those major price swings. But overall, again, nice update for stocks. I mean, I would say from Tuesday close to Wednesday close, plenty to be excited about. The concern I have is just the short-term distribution. We'll see that on the chart of the S&P a little bit later. All right, looking at the bond markets, kind of mixed, to be honest with you. You can see the 5-year point drifted higher. The 10-year point was basically flat, and the long bond yield came down a bit. So the 10-year point, which is what we tracked the closest, was around 4.4%. Look at the intraday movement in the 10-year, this is the 30-year yield we're looking at, the long bond yield. You can see we opened down here. So bonds basically opened higher and then closed lower. You can see that like on the TLT. There's the open, but then look at how it went lower through the course of the day. Prices and yields move inversely in the bond markets if you're familiar with them, and so that sell-off in bonds basically made the 10-year Treasury yield, the long bond yield, trend higher through the course of the day. Dollar index trended higher through the course of the day, not up a ton, about 1% for the UUP, but probably a good sign, right? Because we've seen weakness in the dollar as one of the issues here in recent weeks and recent months. So a nice relief with the pop higher in the dollar. Looking at the commodity side, gold coming down again. Now, again, coming off of new all-time highs, we're still at a pretty high level. I would say the chart of gold is still good. This seems like a pullback within the uptrend for now. We did grab the chart of the GLD for the chart review portion. Noteworthy that silver was actually up today. So you had silver up big. The SLV was up 3.6%, while gold prices were down 2.4%. The rest of the commodity space sort of in the red. By the way, latest episode of the Market Misbehavior podcast just dropped that earlier today. I spoke with Rob Thummel. Rob is a energy expert, portfolio manager at Tortoise Capital based in Kansas City. His career has been in the energy space. I had so much fun asking him questions that have been bugging me about the energy sector in some cases for years. How should we think about crude oil prices? Why? What's the story with energy and crude oil? Why is crude oil not moving the way that you might expect, given some of the geopolitical risk? What's the upside for alternative energy sources, green energy sources, energy infrastructure, natural gas? What about AI? I asked him about everything that I just said and a lot more. Really good interview, and Rob was awesome. I would encourage you to check that out on our YouTube channel, and hopefully very, very soon on Spotify as well. We do have the podcast going there. We should get that interview posted here very soon as well. All right, finishing off with cryptocurrencies, generally high. Bitcoin was basically flat for the day, though. Big move higher yesterday and accelerated up. Cryptocurrencies generally moved higher, with both Bitcoin and Ethereum in the green today. Bitcoin's been trading around 93 to 94,000 over the last 24 hours. The chart of Bitcoin has certainly gone from sideways consolidation to more of an increase, which is a pretty nice move to see. And we did grab a chart of Bitcoin and Ethereum a little later to review. All right, looking at the sector summary, we've got technology up 2.9%, consumer discretionary up 2.2%, communication services up 1.6%. Those are your three top performing S&P sectors. Those are some of the biggest sectors, and they're definitely the growthiest. That's the group of the three growth sectors that I like to that I tend to focus on, all in the green. So again, I mean, no denying this week you're seeing sort of a return of growth. I think the real question is whether it's a sustained move higher or whether this is just part of the normal noise that we're seeing as investors react and in some ways overreact to all the headlines and changing perspective we're getting in terms of policy implications day in, day out. On the downside, only two of the sectors were down today. Consumer staples, certainly one of the more defensive sectors, down 0.6%. Energy, the XLE, was down 0.2%. Materials and real estate tied for third from the bottom, both up about 0.1%. All right, let's see, what else can we look at? The breadth data, I mean, continue to improve. I actually looked at the bullish percent index was up a ton today. For both the NASDAQ 100 and the S&P 500. I grabbed, I think, the S&P's bullish percent index, a little more data to talk about what we've seen from a very low level to now over half of S&P members and a bullish point and figure profile. Could be an encouraging sign. I'll let you draw conclusions as we look at the chart together on stock charts. Elsewhere, you can see the breadth was more up than down. 72% of the S&P names were up, 28% down on the New York Composite. On the NASDAQ, kind of 70 to 75% up, 20 to 25% down. Pretty good day, right? And a broad advance, generally speaking. What else? Looking at the Magnificent Seven and Friends, these leading growth names. We've got some earnings to talk about here. Tesla reported, of course, after the close yesterday. We'll look at what happened on the chart today. Short answer is up 5.4%. Broadcom, Amazon, Meta, both up over all up over 4%, which is a nice rally as well. Netflix, which reported earnings last week, and I think without debate, the strongest chart of this group at this point, up the least, up 0.9%. Apple and Microsoft, two of the big technology names, up just over 2% today. All right, getting to the market carpet. And Tony, thank you so much for a shout out and a tip during the show. I really appreciate that. I think we call that the super chats or something on YouTube. Very kind gesture. You said in your comment that's for the new propeller fund. For more lift out of the dive. Thanks for that. I think we'll all need that, right? If we do get some follow through to the upside, we'll need some optimism. Thanks for that, though. I really appreciate it, Tony. Very, very thoughtful and much appreciated. All right, let's get to the market carpet and focus on how things played out today. I mean, what strikes me looking at the market carpet through the course of the day today, obviously big green boxes in a lot of the big names. If you look in the upper left, we see Apple, NVIDIA, Broadcom, Microsoft, Oracle. Those are the 5 biggest weights in the XLK, and they were all up a pretty good amount from 2 to 5%. And that's certainly helping the technology sector. Look even further, right? Though Palantir up over 7%. A lot of the semiconductor names, software names, all having pretty good upswings today. So again, I mean, no denying, nice bounce higher in growth stocks. In the middle of the heat map, we can see consumer discretionary, Amazon, Tesla, both up 4 to 5+%. In communication services, Alphabet up 2.5%, Meta up 4%. What's so interesting, right, is if you look at like consumer discretionary, take those top 2 names, the rest was kind of right? I mean, cruise lines up, right? Like Royal Caribbean up 4%, Carnival up 3%, Norwegians there up 2.4%. Not bad. Some of the other travel names like Booking up about 3%. That's good. But I mean, generally, a lot of neutral. Same with communication services. If you ignore Alphabet and Meta and look at the rest of the sector, not a great day. So this is one of those, in some of those growth sectors, it was the biggest names looking really good that helped. And I would say secondary to that, a consumer discretionary, a lot of the travel and tourism stocks having a decent up day, but generally not a great sector. Technology is the only one of the 11 S&P sectors that looked like a broad advance, with a couple random outliers like the renewable energy names like First Solar, which had a really good week so far, down about 3% today. Enphase Energy as well, but most of technology had a pretty good day. Other thing I'm noticing here on the right side, a lot of neutral to red in consumer staples. Within energy, utilities, real estate, materials, you can see these were sectors that had less of a decent day today. Financials, very much a mixed bag. I think CME Group was an earnings name this week. There's so many of them. Pretty sure that was today or yesterday. We'll look at. I think I grabbed that chart. But CME Group, underperforming. Chubb down about 2%. Financials kind of mixed, to be honest with you. Had a question. I think that was on the webcast today, or maybe it was on the show yesterday. I believe on can the market rally without financials? And the answer is it can. And I remember having this debate a number of times in previous bear cycles when you're talking about a potential bottom and a potential recovery and what it might look like. There is this sense that, you can't have a rally without financials. That comes from deep history in the markets where financials certainly were early performers that tended to be one of the best signals of a bear phase that was starting to rotate to more of a bull phase. Financials would be early, and then a bunch of growth sectors would come after that, but not always, right? You'll see plenty of times where that actually has not happened. But again, I'd feel better. I'd feel more confident about an upside recovery if you saw financials looking more constructive. For now, I think that's it on the heat map. Let's keep going and talk about some of the individual charts here when we get to the chart review. All right, here's the chart of the S&P 500, and again, a nice gap higher. You probably could label this a bit of a shooting star candle, which is when the open and close are near the lows of the day. You have minimal lower shadow, a long upper shadow. I'm showing this as a bar chart, but just imagine that the left tick and right tick are a little rectangle. That's the body of the candle. And so, again, the reason why that's bearish usually in the short term is because you open higher, you trade higher, but by the close, you're back toward the lows. So there was initial optimism earlier in the session. By the close, we're back at the lows. Those particular candle patterns, like hammer candles at a low, shooting star candles in an upswing, I found to be really valuable because and same with like bullish and bearish engulfing patterns. There are a bunch of candle patterns that I don't pay as much attention to, but those are some of the ones that I found are very meaningful because they really tell the story about what happened over a 1 to 2 day, period, and really helps represent or illustrate the changing short-term sentiment, right? And a day like this, where we gap open, certainly seems to be a lot of optimism. But instead of powering above 5,500, we actually ended up closing below the open. It's certainly, again, and this is the problem I had through all of last week with these up opens that closed lower. We're getting a lot of days where we're closing below the open. And what that implies to me is that during the day, you've got this sort of distribution, right? You've got this lack of willing buyers coming in to buy stock. So great, we're gapping higher. I feel much better about days like this if you closed above the open, if we started to break above key resistance, and I don't see that happening yet. That 5,500 level, though, very, very close. I mean, almost reached earlier today. That's a level that's important because it's a big trend line off of the February peak. I think breaking above that trend line would be pretty encouraging. 5,500 was a Fibonacci level that we talked about, particularly going into that low in mid-March. So I think that's an important pivot point. I think a break above 5,500, you have to start thinking about further upside potential, but still not quite there. And let's see what happens. Again, plenty of earnings still to come. We've got a number of names we'll talk about today, time permitting, but more to get to as we continue. McClellan oscillator back positive. So some of the breadth indicators certainly coming out of very negative levels to less negative, and in some cases actually quite encouraging short-term readings. The McClellan oscillator being above zero basically tells you the trend in the advanced decline data is starting to turn higher. Now, this is, I think, purposefully meant as a short-term measure of breadth, right? I don't think you draw long-term conclusions from the McClellan oscillator. That's where things like the McClellan summation index were really designed more for that, looking at trends in the data over time. This was meant more to understand the short-term swings in momentum, or in market breadth conditions. And the fact that we've spent most of the last week above zero is not a bad thing. That's actually a pretty encouraging thing. The danger here, or what would be a warning sign for this market, particularly given all the reasons for concern that we've been highlighting on the show here, would be the McClellan oscillator breaking back below zero. That's one of the components in the Hindenburg omen, right? As an example of showing that the breadth is rotating from bullish to bearish. So something we'll be continuing to watch this week, but overall pretty good. And another update in breadth today. All right, the bullish percent index, and I actually saw earlier in the chat someone had mentioned that right as we kicked off here. I did notice the rise in the bullish percent index. We're up to over 60%. That's pretty big, right? I mean, earlier this month, right? Earlier in April, we're down here around 12%. So what that means is in the last week or two, off of that early April low, 2 weeks we'll call it, about half of the S&P 500 members have generated a buy signal on their point and figure chart. That's not nothing, right? That's not a minor move. That's a lot of stocks getting point and figure buy signals, and it takes something to actually change that signal from bearish to bullish. It's not just a quick thing. It usually takes quite a bit of an upswing to register that signal. So what does that mean? Well, what I've noticed is we went from a very low level, well below 30, to above 30, and now today popping above 50. So I just did a quick analysis for the last 10 years, and I highlighted with these pink vertical lines anytime the bullish percent index went below 30 and then went back above 50. And I've just sort of pinpointed that time. Now, if you look back at the chart of the S&P, which is in the bottom half of the panel, doesn't seem that bad, right? And you can see a number of times where these signals were actually quite good. As a matter of fact, the last couple signals that we've had have been very good, right? Here in the fourth quarter of 2023, coming off of that October low, we had that particular signal fire. That ended up leading to 2024, which is very good. 2023, we're up another 6 months, we'll call it. That's not true. That's more 4 months from the signal to where we eventually peaked, but still pretty good here. Again, we had about a 6-month, 12-month rally almost, we'll call it. That's not true. 8 months. Sorry, the lines are totally throwing me. That's about an 8-month rally from that signal to the eventual peak. So a number of times where that signal has come before a nice sustained rally. And so I would hazard a guess that if you look like 6 months after those signals, the average return is pretty good. The problem I have is you also had that signal in October of 2015, where we had a brief bounce before a new low. Here in May, June of 2022, where we had a brief bounce and then a new low. Here in July of 22, where we're up for about another month before a new low. So the problem I have with that is in the two kind of real sustained cyclical bear markets on this page, which would be the 2022 bear market. And, I'm not including like 2020 because it was really like a 2-month drop and that was it. That was the COVID low and then a ton of liquidity and everything went back to great. So it was such a quick market. There wasn't enough time to have more of a sustained decline there, right? Because there's a lot of liquidity that was injected to try to save asset prices, which worked pretty well, arguably. But 2022 and like 2015 is you'll get some signals mid downtrend, and I think that's the risk that I see, and why I'm not telling you, hey, it's going to be like you are here and brace yourself for another 12+ month uptrend. I just don't know if I'm ready to make that declaration just yet. But having said that, that's only 2-3 times out of however many. That's 3 out of 10 where it was actually a pretty good signal. Sorry, only 2 or 3 out of 10 where it wasn't where it did not work out very well. The rest of those times it ended up being a pretty decent upswing. So the upside that we're seeing with a lot of these growth names and a lot of other things that are bouncing off of the lows and continue to push higher, at some point that really tilts the needle back toward a bullish phase. So again, bullish percent index, for what it's worth, can't argue that that's a negative signal. I mean, whether or not it plays out with a resounding bull market is the other part of this. But in terms of analyzing the indicator is telling you conditions are pretty good right now. China, let's talk about China, right? Because big headlines, one of the many headlines we're digesting this week is maybe a significant change in U.S.-China trade standoffs. And again, I mean, the lack of transparency and warning before major changes is very, very much an issue that the market is not appreciating, which is injecting a ton of volatility into the system right about now. But let's talk about the chart. This is the FXI, which is one of the China ETFs that I track pretty regularly. So if you look, I mean, what's happened from a technical perspective is we had this gap lower. This is when those tariffs were announced. A couple of really big down days took us right to the 200-day moving average, which ended up for now being a fantastic buy point for the FXI. And that's not lost on me that we hit the 200-day and then had this beautiful bounce. Today, right, and what's happened this week, we've had a couple upside gaps. Today we gapped higher, again, closed back at the lows. We'll see what happens as the Asian markets open here in a couple hours, and then how that translates into the next the European session and the U.S. session tomorrow. But overall, I would say the FXI basically closing at the lows is not giving me an upside follow through type of signal. The other thing to know, we're actually right in the midst of this gap, and I think that's something for a lot of these charts to definitely pay attention to. That downside gap was when the tariffs were first announced in early April. We can see the 50-day moving average is kind of right at the upper end of that price gap, which means we are basically in that gap's range, which is often where you experience resistance. So China has rallied up to the short-term area of support. So buying something like this off of the 200-day moving average as a trade, 100% don't blame that sort of approach. I think that's a pretty good approach to play. The question for a lot of these charts is there momentum to get through to that next level higher? And that's where it's like the RSI is still, I mean, it's right at 50 today, right? And we've seen a number of these charts where the RSI is relatively low, the momentum's low. This one's right at that point where it's pushing to a meaningful level. So no denying a nice rally higher. I think supports at the 200-day until proven otherwise for now. I like the bounce off of those levels. I would love to see us clear that price gap, which would mean a move above 35 on the FXI. I think would clear the way for that chart. Now, where you are seeing some upside follow through is in the cryptocurrency space. I want to highlight that Bitcoin, of course, continuing to push above 90,000 here in the last 24 hours. That gets us back above the 50-day moving average, really completes the rotation above the 50-day, above the late March highs. I think this clears the way to retest certainly 100,000, which is a big round number, and arguably testing all-time highs from January. So nice upside breakthrough. A lot of cryptocurrencies are right at their 50-day. Bitcoin has actually moved a little further than some of these others. Ethereum, like actively testing its 50-day moving average today. Between these two, I think Bitcoin is clearly the better chart from a technical perspective in that it's breaking above moving averages and following through, breaking above resistance. Ethereum still has a little more to prove along that line, but certainly watching the 50-day pretty important here. Gold, and I missed this yesterday. I don't know how I missed this, but I managed to. Boy, I'm not perfect. I'll tell you that. I missed a bearish engulfing pattern on the chart of the GLD. This is the gold chart, and if you looked yesterday, we had this big down day, higher open for a new all-time high on the GLD and a lower close, which is a bearish engulfing pattern. And I apologize, I didn't highlight that yesterday. I certainly would have had I noticed it, because today we have this gap lower. It comes after that 2-bar pattern, the bearish engulfing pattern. Now, gold had been overbought, so some sort of pullback makes a ton of sense from a technical perspective. The question, as always, is this a pullback within a larger term uptrend? And I would say, based on the fact that we're coming off of new all-time highs, we're above upward sloping moving averages. The momentum overall pretty strong, with the RSI almost entirely above 50 in 2025. I'm inclined to give the benefit of the doubt on the bullish side on the chart of gold. Pullbacks happen. They're actually very, very normal within an uptrend. The question is, do you keep making higher lows? And that's what I would be looking for here during this maybe brief pullback phase. We'll see. All right, looking at Alphabet. Let's see, looking at some individual names here. Alphabet actually came up on a question here. The chart of Alphabet is just, it's sort of now, I would say, neutral, right? What's happened up until this week is we've had a very clear pattern of lower highs and lower lows. And that just almost hasn't even, been broken from this peak here, right? This is the peak at the beginning of February. We gap lower, which is called a breakaway gap, and then we trade lower. We have lower highs on rallies. We have lower lows. We continue. All of a sudden, we have this, and this is something we're seeing obviously in the chart of the SPY and the Qs as well. We're sort of making a higher low. And so, what do you do in this in this environment? So, I would say a couple things you can do, right? Number one, you can go a little shorter term, and you can say, all right, I'm going to draw a trend line, this little trend line here, and say, as long as we hold above this trend line, short-term trend is pretty good, right? So do sort of this kind of game where you're, connecting that low to that low and saying, all right, maybe this is a short-term recovery. I'm betting on that. I think the more conservative approach, which is what I tend to favor, is you look for follow-through, right? Higher low is good, but breaking above, right? Making a higher high is what's really important. That's why the chart of Bitcoin starts to really look interesting to me, because we're like breaking above that swing high as we push above 92,000. Here with Alphabet, that's around 162, which would be the swing high from mid-April. Can we get above there? So that's like your downside risk using this trend line, but really the trigger is getting out of that level. Getting above moving averages, higher momentum, all of those things I think make a chart look more constructive. But I think the chart of Alphabet for now, it's sort of less negative because we're making maybe a higher low. Still not an uptrend because we're not really breaking out in any meaningful way. But that's where we're really close to getting above those swing highs that I think could make this a much more compelling chart here. Netflix, by the way, stalled out today, a doji candle. Yesterday, we pushed above 1,000 and retested the February all-time high. Did a tick or two push above there, it looks like. But then today, a doji candle, sort of a standoff, an indecision day where we did not have the upside follow-through. So still wait and see mode with Netflix. Could be a major double top pattern that we're forming here. Overall, the stronger momentum, the fact that we're breaking above 1,000, I think that's all encouraging. And again, compared to any of the other Magnificent Seven stocks, that's probably my favorite chart of the group. Apple remains above this trend line. We drew these trend lines and shared them on the show yesterday. I just want to show the gap higher today after yesterday's gap higher. That's all good. But again, still below trend lines I can draw. RSI still below 50. Tesla, we talked about in the after hours yesterday because they reported earnings after the close yesterday. Certainly a lot of optimism that I saw in recaps with, Musk talking about unwinding his Doge career and getting back to the company and et cetera, et cetera. What happened to the stock today? Well, we closed up about 5.4%. Earlier in the day, we had traded a bit higher. And so overall, no change, right? From a technical perspective, this is still a sit on your hands kind of period. And the reason I say this is because, again, we're kind of trapped between support at 220. We're kind of caught between resistance at 290 at the 200-day. One of these things breaks, right? We either break above the 200-day or below 220, and that would be the trigger I would be waiting for. For now, I think this is a neutral chart until proven otherwise. As long as it doesn't break 220, it's not a bad chart. It's not a great chart. Berkshire Hathaway is a really interesting one. The momentum is almost dead neutral. You can see the RSI has been fluctuating above and below the 50 level. We're making some brief lower lows off of that late March high around 540. We're having some lower movements. We're actually seeing some higher lows as well. So, so sort of chopping around here. This is definitely a noisy period. Now, this is all during the tariffs. While a lot of things have broken down and stuff, Berkshire Hathaway is actually holding up quite well compared to others. We're still above 2 upward sloping moving averages. That's my go-to with something like Berkshire Hathaway. It is one of the few individual names that I hold as a long-term holding. Got it in a retirement account. Don't plan to sell it anytime soon. It's just been a great long-term compounder of gains, and I don't see anything on the chart telling me to be too worried about that. The fact with all this tariff noise and stuff, it's still above 2 upward sloping moving averages is pretty important. All right, we've got Blackstone, and again, we've had a number of questions about the financial sector. I mean, this just isn't a good chart yet. I mean, is it a horrible chart anymore? Maybe not, because we're starting to maybe make a higher low, which is good. We have this bullish divergence from March, April on higher lows. That's good. But it's still going down, and the relative strength is still underwhelming. And this is what prevents me from being really excited about a chart like this. If you watched the webcast earlier today, I mean, this is somewhere kind of between buy point 1 and buy point 2, sort of like, is it still in a downtrend, or have we had enough of an improvement that it looks like you can start to accumulate by seeing signs of optimism? I'm not sure about that second point just yet. So I'd probably be waiting and seeing on that one. IBM, by the way, bouncing off of the 200-day moving average as well. Now, this is an earnings name today. We have a couple names to report on that reported earnings. Let's look what's happening after the market. So it's getting dinged in the after hours trading, down about 5.6% to 232. That's still not bad. That's kind of right around that swing low just from Monday's session. So short answer is IBM still good on the long term, and that it's above an upward sloping 200-day. We had this doji candle as we test the 50-day. Looks like earnings are going to be a little weaker, which implies we, tomorrow's session kind of opens down around this range. We'll see what happens again between today's after hours session and tomorrow. But IBM was one of those technology names actually holding moving average support pretty well. And I think as long as the 200-day holds, the long-term trend is still good, but the short-term trend is what could be a problem after a potential earnings miss. ServiceNow is a software name. I forget if they were before the open or not. I apologize. I should know that off the top of my head. Ooh, up big. I'm guessing after the close with up about 10.5%. So it's currently trading around 898, which is getting us back up here. So the bull case for charts like ServiceNow, and this is what we talked about going into this week. Some of these names that have been underwhelming, earnings can often provide a good upside catalyst. So if we do get a 10% gap higher and we open around here tomorrow, that could be a really encouraging, a nice follow through. Getting above the March swing high would be good. And I think the 200-day moving average then the key level to watch. O'Reilly is a good one because a lot of auto parts companies have been some of the better charts in 2025. They've actually held up very, very well. Looking at the chart after the close, down about 1.4%. That's not much, like 1360. I mean, that's pretty much like right there above the 50-day moving average. So still a pretty good chart. And again, scanning for names above the 50 and 200-day moving averages in this environment, good way to find charts like O'Reilly that are still holding up quite well. Boeing reported earnings before the open. You can see we gapped higher. We ended up closing about 6% to the upside. The problem I have with the technical perspective on Boeing is this major overhead resistance. This is where we stalled out around 182 to 185 or so in December. Again, in January, February, March, we're kind of getting back up to those levels. So a chart like this that's had a number of tests of resistance and have stalled out, I kind of want to see it break out of that resistance, implying that we're through that point. That's an area of supply where investors are tending to unload. Do you see additional demand coming in and pushing us above those levels? That's what I'd look for there. Finally, CMA Group, another one reporting before the open today. They were down about 1.5%, still closed above the 50-day moving average. So similar to some of the other names that we've talked about, I think the fact that we're holding the 50 and 200-day, pretty encouraging. All right, take a couple questions here from the chat, and then we'll be done. Titus Ryder, as always, thanks for watching. Berkshire versus S&P relative strength is very strong. Why do you think that's a recent occurrence? Interesting question. Let's take a look here. So here's the chart of Berkshire Hathaway. Oh, I see what you're saying. You're saying like back here, why is this just a recent occurrence that it's outperformed? So, I mean, what you have to remember, right, is it's like two different market phases, right? In 2024, you have the S&P and a significant uptrend, right? I mean, kind of everything working in 2024. So while Berkshire Hathaway was up in 2024, obviously, it's kind of the market, right? I mean, if you look at the end of 23 and the end of 24, the fact that the relative performance line is flat basically says you basically were in line with the market during that period from the end of 23 to the end of 24. But from, end of 24 to now April of 2025, Berkshire Hathaway has continued a primary uptrend while the major averages have come down. This is why relative strength, I think, is so valuable, because it helps you understand how this part, while up on an absolute basis, kind of everything was up on an absolute basis. Not everything, but you get the idea, right? Bull market, most things are doing well. Berkshire didn't really differentiate itself on a relative basis. 2025 being up like this is a huge deal because most things are down year to date. And so I think that's why the relative strength is so important, particularly in this environment, to help you identify things that are doing better than the benchmarks. That's why the relative strength is looking so important now. All right. Like Richard, I saw a couple posts here. Dave, the bullish percent index went up, but has volume increased to validate its bullishness of trading today. Now, that is a really, really good point, and I appreciate you so much making that. The bullish percent index, which you have to remember, it doesn't include volume at all, right? I mean, it actually intentionally does not include volume because it's just looking at how many stocks are behaving in a certain way. The idea is volume, or what I see as the idea is volume is something you consider separately, right? You think about breadth, you think about trend, you think about momentum, you think about volume, sentiment. These are all different sort of areas of the technical toolkit to help you evaluate market conditions. And sometimes they will all kind of agree, sometimes not. And so to answer your question, what about the volume behind that particular move? That's not what I wanted to do. I wanted to look here. On the chart list, the chart that I'm immediately thinking of is the Chaikin money flow chart, because that gives you a good sense of volume. All right, here's the SPY. We can see here the rally off of the March lows. Here's the daily price bar or daily volume bars in April. Red means it was a down day in price. Black means it was an up day in price. We can see the big spike in volume on the sell-off. We can see from there the volume really evaporated. Over the last week, though, kind of steadily increasing. And today, not bad. We're actually seeing like above average volume, certainly compared to what we were seeing in the 12 prior months. We still have actually pretty high volume relatively. So the volume is actually increasing on these up days. That's actually a good sign. The Chaikin money flow, however, is still negative. And the reason why that's the case is because you have these days where we're closing in the lower half of the price bar. This is why I love the indicator Chaikin money flow. What it does is it basically says, this day's volume, is it bullish or bearish, right? We gapped higher, but we closed lower. And so you could make a couple different arguments. Chaikin's approach with this indicator is to say, I don't care about price caps. What I care about is what was today's range and where did we close? So the fact that we closed near the lows of the day means most of this volume was basically selling pressure, and very little of this volume between the low and the close was actually accumulation, right? Because if during the day we're distributing shares and adding supply, that pushes prices down. If there's more supply than demand, we close near the lows of the day. That's a distribution day. So the Chaikin money flow is still kind of negative for the last week, even though we've seen the market gapping higher a bit on stronger volume days. So the short answer is it's kind of mixed. And I would say, a bullish percent index, encouraging, the volume not as good. And I would say the volume, the thing that concerns me about the volume is generally lighter volume, but also the fact that these down days between, during the day, the fact that we're closing near the lows of the day implies distribution. And that's why the Chaikin money flow remains below zero and basically tells you the volume's not there for a sustainable gain. Thanks for asking about that, by the way. That relationship, thinking of breadth and then thinking about the volume implication, that's advanced thinking, I would argue, about technical analysis. Thumbs up and kudos to you. Folks, that'll do it for today. We did not get to all of those questions, but there's some good ones in there that I'm looking forward to answering on my Friday all mailbag episode. So I hope you will join me there. In the meantime, have a fantastic evening. We'll be back with another show tomorrow after the close. But between now and then, be well. And remember, it's always a good time to own good charts. Have a good night, folks.